ಅರ್ಜೆಂಟ್ ಇಲ್ಲ ಆಮೇಲೆ. ಹಾಂ ಓಕೆ. Okay, let's settle down, please. Okay, so I made an announcement in the morning class, so it's only fair that I repeat it again. If you can't sit quietly in the class, please walk out right now, because I don't want to kind of get disturbed in between. So the contract that we have is that if you're going to sit in the class, then you're going to be quiet, right? So without making any noise. But if you can't do that, let's just sort it out, and then you guys can walk away right now, so that I don't have to kind of get upset in the middle of the class that you're creating noise and then disturbing all of us, right? So I'll give you 1 minute if you want to kind of pick up your things and then walk out. If you feel that you can't keep quiet in the class, then I'll give you a minute and you can walk out, and then we can start the class. Okay. Okay, so since you have chosen to stay back, I want pin drop silence from this side, right? Okay, so we go to the next topic, which is we'll understand a bit of budgeting, and then we'll close the class. I mean, close the course rather. So look at the simple example. So we have some details that are given for for this particular month, and as we have discussed before, but budget is essentially like a plan that is given structurally in numbers is what we call as a budget. And if you look at this particular budget that we have here, this is a company that is making and selling jackets, and we have a budgeted selling price. So the company is planning to sell it at 120 rupees per dollar, 120 rupees per jacket, or $120 per jacket. And there is a material cost of 60. There is a labor cost of 16 per unit, and then there are these manufacturing overheads, variable manufacturing overheads. There are fixed manufacturing overheads, and the capacity is to manufacture 12,000 jackets. So that's the data that we've been given for this particular month. And we also have some additional information here, which is in terms of standards, or what is the standards the company has established. And you can see here that the company wants to spend or wants to use 2 square yards of cloth per jacket, and the cost per square yard is 30. So obviously 30 into 60, sorry, 30 into 2 is 60. This is what is the material cost per jacket. And then you have the labor rate per hour, which is 20, and also the number of hours that is required per unit on average. And if you multiply these two, 20 into 0.8, you will get 16. So I'm just telling you that the data is actually internally consistent. We actually won't be using too much of this, because this is where we actually get into detailed, what we call as variance analysis. But that's something which we unfortunately don't have the time to do. But I just want to give you an intuition as to how things work when it comes to budgeting. And the most important thing is not to have a budget, but the most important thing is to compare the actual performance with the budgeted performance. So this is the planning that has gone. and these are the actuals which is there for this July. So in July, the actual number of units that were sold was 10,000, and the sales amount was 12 lakh 50. And then you have the other costs which are there. So what has happened here is that we have the budget details which is there for July, and then we have the actual numbers which is there for July, and we have calculated the profit. So the profit is just sales minus all these costs. So this is the monthly profit that we have, and as the problem is asking us, you're required to assist the top management in analyzing the company's performance, right? So in this particular month, so normally what companies do is they meet towards the end of the year so that they can draw up the budget for the next 12 months for the next year, and then there is a review of actual versus budgeted performance every month. So typically in the first week of the month, so last week of the month, the finance department typically is busy with collating all the information, making sure the reports etc are done, and that happens not last week but then maybe last few days of the month, and then it continues on to the next couple of days in the month. And typically there is a review meeting which is there which is held towards the end of the week of the following month, where they will kind of review what was the budget and what was the actual numbers and what was the reasons for the difference. So that is what we are supposed to do right now. Are you with me? Okay, right. All right, yeah, go ahead. Yeah, so when we say standards here, we are talking about this whole concept called standard costing, where the company has established that look, under normal circumstances, I should actually be using 2 square yards per cloth. So this is part of standard costing, and these are standards that the company has established. So now you can also make this analysis, right? So if everybody in the industry is using 1.5 yards per jacket, then you can actually question the standard itself, the company standard that has been established. But for now, we're just keeping this as a standard because you don't have any information as to what is the normal, resource usage in the company. Could you explain that? Huh. Hmm. Hmm. Yeah, of course. Yeah. So see, normally what happens is, when you when you have to have a plan, the budget plan is typically done once a year, because there's a lot of people who are actually involved there. So then what typically they will do is you will have a plan for the entire year, and there'll be some leeway that is given where you can kind of go this side and that side a little bit, and every month you review the performance. So every month the budget doesn't change. Every month what changes is the actual performance that is there. And now your point about using the previous month, so for example, now this is for July. Correct. So now the point is the budget for June and July will be the same. It is not going to change, right? But what some companies might do is they might have the actuals for June and the actuals for July to understand how the actuals have changed between June and July, right? But they always need to be compared with the budget as well. So the June actual will be compared with the June budget, which will be the same, the same numbers will be there for July as well. And the July actual will be compared with the July budget. That's exactly. See, what you have to understand is that the whole point of variance analysis is not to see that there is no variance. In fact, if there is no variance between budgeted and actuals, then it's almost guaranteed that there is some fraud or there is some fake thing that is going on, right? Because the default is that you should expect that there has to be a difference between whatever has been budgeted and whatever is actuals. But the point is that once you have the difference, once you've established what are the differences, then you have to kind of investigate as to why the difference happened. Is it something that was under the control of the company and which can be controlled, or is it something that was beyond the control of the company and hence something that cannot be controlled, or is it something that where, let's say that the industry standards have changed, but then we haven't updated our standards, so that also could be a case. So in order to do that, you will have to first do this exercise in terms of comparing the actuals versus the budgeted. Are you with me? Any other questions? Okay, so let's say this data is given to you. How will you approach this? What will you do? That's okay. Just one thing, ignore the right side because we will not be using this, because when we do full-blown standard costing, then we'll use this data. So ignore this side. So assume that we have only the data which is given in columns A and columns B. The reason I don't do full standard costing here is one, of course, lack of time. I mean, when I was planning the course. And the second thing is typically that standard costing is typically applies to larger companies, and somebody in the costing department will take care of it. But as an entrepreneur or as a manager, you just have to be aware of the basic approaches of how this particular variance analysis works, right? So we limit ourselves only to that. Okay, yeah, yes, Ishan, go ahead now. So you have the data which is there in A and B. So before variance analysis, is there something else we need to do? No, but there is something else that you have to do before you start doing that. I mean, something else that you have to prepare before you start doing that. Okay, we'll just come to that in a minute. But then, what is the first thing that you will prepare if you want to figure out if you've actually made sufficient profit or not? What is the first thing you'll prepare? You have to prepare a P&L, right? So because the whole point is that whether the company has made a profit or not. So we will prepare what is called as a budgeted P&L, and we will prepare something called as the actual P&L, right? So we will look at this where you look at what is called as a static budget, because this is the budget that we have which does not change month after month. So we have the static budget in terms of what should be the sales, what should be the unit price, etc., and therefore what should be the total sales. And then you have all the expenses that you have here. We are following the contribution format, right? So where you put the variable cost first. So these are the budgeted numbers. So you get the total variable cost, then you get the contribution. Then we have the fixed overhead, and then you end up with the operating profit. So that data was not given to us, right? So first thing is we have to prepare this statement, the performance that is there of the company. So you prepare the budgeted, P&L, where the budgeted profit, the company was supposed to earn 1,08,000 profit in this particular month in July. But when you put the same actual numbers here, you see that the operating profit is only around 15,000, right? So you have the budgeted P&L which is there here. You have the actual P&L that is there here. And then you're just looking at the difference between these two, the difference between the budgeted numbers and the actual numbers. So one of the things that we do in variance analysis is there are different ways to do it. But one of the things that we do is whenever there is a something to do with sales or something to do with income, the way we do the budgeting is when we calculate the variance is we do actual minus budgeted, right? So what does it mean? It means that if you look at the sales figure that is there, the actual sales is 12,50,000. The budgeted sales was 14,40,000, and so the difference is 1,90,000 negative. So a negative number indicates that look, I had to make sales of X, but then I ended up making sales of lesser than X. So it shows that there is a negative number. So we don't like, or rather, when you look at variances, a negative variance indicates that something is reducing your profit. A positive variance indicates that something is increasing your profit. So if you have to have that relationship between negative numbers and positive numbers, then what we do is for sales or any income that you have, you look at what is your actual number minus your budgeted number. But for costs, we make it reverse. We make it budgeted minus actual. Why do we do that? For costs, why do we do budgeted minus actual and not actual minus budgeted? Well, the answer is there on the screen. Yeah, but then why did I do actual minus budgeted for sales? Budgeted is not fake data, but yeah, my plan. Okay, yes. No, but that's different, no? So that is in the way you are doing financial accounting, but that's not relevant here. So yes. not spent, but we made more sales. Huh. Sorry? Yeah. So essentially, the point here is that would you okay? Let's say that you have a budget, and I tell you that you can spend, or rather, the sales that you have to achieve is 10 lakhs. If you achieve 15 lakhs, are you going to be happy or sad? You're going to be happy, right? But if you end up getting a sales of only 8 lakhs, then have you met the target? You've not met the target because the target was 10 lakhs. But then use the same numbers for cost. So if you're allowed to spend 10 lakhs, and if you spend 15 lakhs, is that good news or bad news? That is actually bad news, right? But then if you spend only 8 lakhs, it means that it's actually good news. So the what I'm trying to say here is that look at what I have given here, right? So when I do this, in both cases, positive means that it's a favorable result, and negative means that it's an unfavorable, or what we call as an adverse result. So these are the standard terminologies which are used in costing. We can just stick to favorable and unfavorable. So whenever you look at a variance, if you're talking about a favorable variance, it means that that is increasing your profit as compared to the budget. If you're talking about an unfavorable variance, it means that it is decreasing your profit, right? So your favorable variances, we can show it as positive, and your unfavorable variances, we can actually show it as negative. So look at what we have done here. So if you look at this, my sales was expected to be 14.4 lakhs, but the actual sales is 12.5. So my variance is a negative, 1 lakh 90, which indicates that I had to make sales of 1440, but then I ended up making sales of only 1250. So therefore, I have a negative variance, which shows that I am short of the sales by 1 lakh 90,000, right? So, but if you look at direct material budget, the budget allowed me to spend 7 lakh 20, but I spent only 6 lakhs 21. And if I take the difference between these two, then I end up with a positive number, which means that I was supposed to spend 7 lakh 20, but I spent only 6 lakhs 21. So therefore, my variance is close to plus 1 lakh, which means that I have spent lesser on materials, and so on and so forth, right? So the same thing applies for all of them. So what you can see here is that if you go step by step, you can see that I had lesser sales, but I spent less on material. I spent a little bit extra on labor. Again, I spent lesser on my variable overhead, and compared to 1 lakh 44, I spent only 1 lakh 30,500. Then in my fixed overhead, I spent a little bit extra, where I spent 9,000 extra, and ultimately my operating profit is short by 93,000. So that is why I have shown it as a negative number there, right? Because my operating profit, the planned operating profit was 1 lakh 8,000, but then actually I made an operating profit of only around 15,000. So therefore, my profit shortfall was 93,000. Are you with me? So there are some positives and negatives here, and this actually gives us how the variance is there between the budgeted numbers and the actual numbers. Okay, so if this is the calculation that you have done, and now you have to kind of analyze this, right? Because you've just done the numbers for now. So if you analyze this and you have to tell something to the management, what will you do? What are the insights that you can get from here? First of all, are you okay with this? Any questions? Any part that is not clear? Huh. Right. Why is that a problem? Yeah, I mean, per unit. Okay, per unit we can do, but then we are looking at the overall level. We can do per unit later. If you see that there is a per unit data that is given there below, but why is that? I mean, why? What is the need to do that? Okay. Okay. So can you talk specifically in terms of direct material? Can you explain that using that example? Hmm. Hmm. Right. So obviously, then it's an apples. It's not an apples to apples comparison, right? So because column B is for 12,000 units, but column D is only for 10,000 units. So therefore, the comparison actually is not correct. So this is what we are ending up comparing apples to oranges. You had something to say? Okay, Ishan already made that point, right? So he was saying that look, first we have to change the numbers to reflect what is your actual output, right? So what we do is you start with the static budget, but then we calculate something called as the flexible budget, right? So there's something called as a flexible budget that we will calculate, where we will say that, look, our actual numbers are 10,000. So we need to get a budget that is there for 10,000 units. So look at the flexible budget now. So in the flexible budget, what we do is we say that, look, let's take the number of units, which is 10,000. And my selling price is 1 lakh, 120 per unit. Therefore, the total sales that I actually had to have is 12 lakhs. Now, if I compare column C and column D, it makes better sense. Why? Because these are my actual numbers. Obviously, actual numbers cannot change. So I have to redraft my budget so that I get a budget for 10,000 units, which is the actual numbers. So when we are looking at the flexible budget, what we are trying to say here is that let's take the actual numbers that happened in this month, because at the end of the month we have the data, we have the actual number of units that are being sold, and use that to recast our budget, what is called as the flexible budget. So the flexible budget is a budget that is prepared for the actual number of units that actually got sold in that particular month. This variance analysis makes better sense as compared to looking at the variance analysis between static budget and the actual numbers. Are you with me? Why we need to do that? Okay, so now we'll prorate everything, right? So one simple way to do this is, if you look at the flexible budget and if you look at the direct material, so what we will do is we are just prorating here, where of course, we can, I've used a different formula here, but what I will do is I will do 7,20,000, which was supposed to be for 12,000 units. And then I will multiply that with 10,000 units, which gives me the 6 lakhs. Or what I can do is, the way I have done here is that you look at whatever was the budgeted cost per unit. So if you go back to the data that was given to us, the budgeted cost that we got was, the direct material cost was $60 per unit, or 60 rupees per unit. So I'll multiply 60 by 10,000. That is what I've done here, right? So this is 60 multiplied by 10,000. And that gives me what should have been the consumption of direct materials as far as my budget was concerned, if 10,000 units actually got sold. So you do the same thing for direct labor, for variable overheads. But then for fixed overheads, we will retain the same, because by definition, fixed overhead means that there is no changes in your overhead based on your the number of units that you have. So whether you're going to manufacture 12,000 units or you're going to manufacture 10,000 units, the fixed overhead is going to remain the same, which is at 2,76,000. Are you with me? Okay. Any questions? Okay. Now let's look at the per unit data. Between under the same three columns, right? So you have the static budget, the flexible budget, and the actuals. So what you can see here is that if you look at the per unit data, there won't be any difference between static and flexible, because the only difference between static and flexible is the number of units. So your per unit data, there is not going to be any difference between static and flexible, but there is going to be obviously a difference between what is your actual and your flexible budget. That's a point that we need to kind of keep in mind. Are we good? Okay. All right. So let's go on. And one of the reasons, okay, can you tell me why we just don't do per unit? Why do at the overall level? Because when you look at the overall level, we get into this issue of static and flexible and all those things. But then I just told you that there's not going to be any difference at the per unit level between static and flexible. Why don't we just do the analysis at a per unit level? And why do we have to do it at the overall level? Why do we have to have the overall P&L? Yes. Yeah, so one of the things is that you're not accounting for volume in the per unit level, because we also need to have an understanding of the volume. Are volumes important? Right. Obviously, your volumes are important. So you'll have to account for that volume as well. So you can do the accounting for the volume only when you do it at the overall level, right? Is there any other reason why we need to do it at the overall level? Okay, another reason why we have to do it at the overall level is that if you have to understand fixed cost, it can be done only at the overall level. Because on a per unit basis, we actually don't define fixed cost, because we know that the more number of units you produce, the lesser your average fixed cost is going to be. And that is the reason, if you look at the per unit data that is there, I stop at contribution. I don't go below contribution, because this particular unit is, or analysis is telling me that, look, I can do the per unit analysis only till the contribution level. I cannot do a per unit analysis when it actually comes to the fixed cost. So to understand fixed cost, I have to do it at the overall level. So two reasons again why we do the overall variance analysis. One is because we'll have to account for volumes, and the second thing is that if you have to analyze the fixed cost as well, then we can do it only at the overall level and not at the per unit level. Are you with me? Okay. Now look at the flexible budget variance. Let me hide the static budget variance which is there here. Sorry, because static budget is not important. But then static budget, okay. So by the way, why is static budget important? Because that is like a benchmark, right? But then you use a static budget. So every month, what you do is you start with the static budget, then you recast the static budget to reflect the actual number of units that have been sold, and then we do a comparison between the flexible budget and the actual number, right? Okay. So now, given this variance analysis, what would you say is happening? Start from the top, no? From sales. Okay. So, okay, one second. Why is the variance 0 here? Yeah, so it's by design they have to be equal, right? So there is no variance as far as volume is concerned between flexible budget and actuals, because that is how we calculate it. The flexible budget is based on the actual number of units. Obviously, there's not going to be any variance when it actually comes to the number of units between flexible budget and actuals. But in selling price, you see that there is a 5 rupee increase in your actual numbers as compared to the budgeted number. So it means that for every unit that you sold, you were able to sell it at 5 rupees higher, and that's the reason when you sold 10,000 units, that actually added 50,000 to your top line, because 10,000 into 5 actually comes to 50,000. Are you with me? Okay, all right. Then how do we understand the remaining ones? Yes, can you continue? Okay. Uh, right. So which gives you a total of the variable cost has increased by roughly around 70,000. Is it good news or bad news? Obviously bad news, right? More cost means that it's bad news. Okay. What about the remaining ones? Okay. Okay. Yeah, not negative. Yeah, right. So for this level of 10,000, amount of units that we sold, our budgeted profit level was around 44,000, but we ended up, getting only 14,900. So there is a shortfall of 29,000, right? So once you have this, then what do you think we should do next? Let's say we have done this and we've kind of, got these numbers. Okay, right. So, for example, let's take direct materials. So, what could be a reason that we ended up spending 21,600 on direct materials? Okay, so there are only two reasons why your direct material cost will increase. Either the amount of quantity that you used has been more than whatever is the standard, or the price that you paid for your raw materials has increased. Because what is overall cost? Price into quantity, right? So then what we do is, which will not be doing now, but I just want you to kind of have at least an intuitive sense of that. So now what we will do is, we'll break up this 21,600 into what we call as a quantity variance and a price variance. So when we look at this 21,600, we will try to figure out as to the reason why we ended up paying 6,21,600, but whereas we had to pay only 6 lakhs. Then you will try to find out as to was the reason that the number of units that, or the number of input that was used, was it more than whatever is the budgeted number of inputs? Because remember that if you go back to the data that we saw earlier, we said that for each jacket, we had to use 2 square yards of cloth. So our cost can increase because I used more number of units to manufacture, or it could also be that I ended up paying more per unit of per square yard, and that could be a reason why my material cost is. Give me 1 minute. Let me just finish this point, and then I'll take questions. Are you with me? Okay. So there are formulas for doing this. So if you look at variance analysis, I think in the textbook, if you want to read more about it, you can look at chapter 10 and chapter 11, where we talk about where the textbook talks about variance costs and standard costs, etc. Sorry, it talks about variance analysis and standard costs, etc. But then that is getting into a little bit of detail in costing, which I think is actually not required for entrepreneurs and managers, right? So yeah, you can do that. But let's get an intuitive sense for that, no? So let's look at the additional information that is given here. So what you can see here is, if you look at the quantity was supposed to be 2 square yards, right, which you're supposed to use per jacket. But then if you look at the total jackets that have been, the total square yards that has been used, it is 22,200. If I divide that by the 10,000 jackets that has been manufactured, what you can see is that I have used more quantity on average per jacket. I have used more cloth, right? So where I was supposed to use only 2 square yards, the company actually has used 10% more, roughly, right? So they have used 2.22 square yards on average. And this tells us that there has been extra, quantity that has been used. This specific question on this? Yes, go ahead. No. This is only the point is that this is the unit of square yards that you have used. No, we are not talking about price at all. We're just talking about the quantity. We still haven't come to that, Ishan. So we're just looking at the quantity. So I'm not talking about price at all. So the comment that I have right now is in terms of quantity, how much extra has been used. That's all. But it's important to look at that as well. So look at price. So what was the price per square yard? Right. So I was supposed to pay 30, or I had budgeted 30, but I ended up paying only 28, which means that roughly there was a slight decrease. So roughly maybe around 6% decrease because from 30. So essentially what has happened is I was supposed to use a certain quantity, but then I ended up using a larger quantity based on what was as per my budget. I was supposed to pay a certain amount per square yard, but ended up paying the lesser amount, for that, right? So the combination of these two is the 21,600 that I, ended up doing, right? So in fact, if you come to, this is a detailed variance analysis that we are doing. So what we do is by using this formula, we break this up into what is called as a quantity variance and a price variance. Quantity variance, we also call it as usage variance. Again, this is not required for you to study. I'm just giving you a sense of this, right? So where you're saying that, look, the negative number I have as 21,600. If I break this up, it breaks up into roughly around 44,000, where I ended up gaining on account of lower prices. But I ended up spending more because I use more quantity, and the net effect of that is a negative 21,600 that I have, right? So this is when you go into detailed variance analysis, which you don't have to do. This is just to give you an intuition as to how we kind of try to figure out as to where things have gone wrong. So the whole idea is that instead of just looking at the overall profit number, you dig a little deeper and then try to be, and then you will try to see what is the kind of correction that can be done. Okay, yes. You had a question, Nishan, previously? No, okay, right, yes. He's saying don't use my name, right? So, it's, yeah, go ahead. 2 rupees. Uh, no. No, that's a wrong interpretation. No? Yeah, correct. It's not amount. It's the number of units, the jackets that you have actually got. That's fine. That's fine. Okay. So, what is the overall message we are getting as far as direct materials are concerned? What do you think has happened? uh, Correct. I mean, that's what we saw with the numbers. What do you think might have happened? Uh, I usually ask that question. Yeah, no. I'm just pulling your leg. Right. So I think I have to have a board, saying that am I scolding you or am I pulling your leg, right? So first I have to show that and then, pass my comment. But yeah, so what I'm trying to say is, in reality, again, think of it from a business point of view. So think of it from the purchase manager's point of view, because there's a purchase manager who's probably doing all these things. So when you're purchasing, if you're looking at the purchasing activity, what has happened with respect to the purchasing activity? So you have the numbers here, and I'm asking you to interpret the numbers and tell me what would have happened in terms of the purchasing activity. Think of it from the purchase manager's perspective. Yes, there is more purchase of goods. Okay, that's fine. Not a miscalculation. Why? Why do you think? Okay, think about this. Why do you think more material has been used on average, and why do you think the price actually has come down? We'll come to that. Huh? Yeah, but then why do you think? Can we actually have an explanation? There's a single explanation that is possible for higher price and sorry, lower price and using more quantity. Right. So one way to say that is that, look, the prices of the raw material has decreased, so therefore the labor has been freer in using the cloth, and that's one way to look at it. But then if you think about it in reality, right, the labor actually doesn't get to know what is the price of the cloth. It's only at the supervisor level or the manager level that you get to know, or the production department will not get to know. Only the purchasing department is the one that gets to know. It's very unlikely that the labor will would have used that. But there is one more reason why we are seeing the numbers that we are seeing. No, answer this specific question, but another interpretation will come to that later. Uh, no, not so complicated. It's a very simple answer. I'll let you talk later, but then let's actually sort this out. Quality is the issue. What happens with quality? If you look at the price and the quality relationship, typically, if you need a higher quality cloth, then should you pay higher or lower? Obviously it's going to be more expensive, right? So one interpretation that we can have from the number, I'm not saying that's the only interpretation, but one interpretation, reasonable interpretation that we can have here is that probably the purchasing department has bought lower quality cloth, and that is why they were able to pay only 28 as compared to 30. But then since the quality of the cloth was lower, probably there was more wastage when it actually came to the production process, and that wastage is what actually has contributed to the 2.22 that has been used. So remember that the actual number of material that will go into the jacket can be only 2 square yards, right? Because there will be exact size specifications, etc. But the point is, for making a jacket, you might have to end up using extra material, because when you're cutting it or something, there is a tear, so therefore you can't use that. So you have to dispose that and then use something else. So one way to interpret this is that you can say that probably lower quality material was purchased, which is consistent with the lower cost per square yard that we are seeing, as well as the extra usage that is there. So when we do this, when we break up the direct material variance into what we call as usage variance and the price variance, it gives us an idea as to what could have gone wrong, right? So then, like how we did in ratio analysis in financial accounting, right? So when you look at ratios, you calculate the ratios because you want to figure out as to where are the places you want to focus your questions, or where do you want to focus your investigation, and based on that you'll do more digging. The same thing applies here as well. So now that this is the case, the first place that I'll go is I'll go and look at my purchasing function, and I will see if it is like a is it like a genuine error, or is it an error of the supplier, or is there like a some kind of manipulation that our purchasing manager is doing, or do we need to improve our quality checks, etc. So there's a host of things that I need to do as an entrepreneur or as a manager, as a plant manager, to figure out as to what exactly was the problem. But when you do the variance analysis, it tells you where the problems might be, so that we can focus our energies there. Are you with me? Okay. Yes, Ishan, you wanted to say something? You said you had some other interpretation. Okay. Yeah. Correct. Yeah. Right. Right. No, all those things will be considered when you actually arrive at the standard of two, square required per jacket. Yeah, that's there. So I think you were saying that if it's a new company, then what happens? Then that's correct, right? So maybe they don't have enough experience, and then they'll just go by what is the material that actually goes into the jacket. And this is where we also have to discuss these concepts of normal loss and abnormal loss. I think I spoke about this some time back, maybe in this course or in the previous course. So normal loss means that whatever you do, there is going to be some sort of a wastage that is there. So that is what we call as normal loss, and anything above that is what we call as abnormal loss. So one of my favorite examples is look at all this Nandini and all those people, right? So dairy, when you have you will expect that there is some sort of evaporation loss that is going to happen, and whatever you do, there is no cost effective way to make sure that the normal loss does not happen, because it is under the normal course of the business or the production process that is happening. So it is unavoidable. But abnormal losses will be where, let's say that a tanker develops a leak or whatever it is, right? So which doesn't happen often. That is what we call as avoidable loss and non-avoidable loss. So normal loss is something that is unavoidable loss. Abnormal loss is something that is avoidable. Are you with me? Okay. Any questions before we go ahead? Anybody else whom I didn't give a chance to speak? Okay, all right, let's move on then. Again, I will share this entire file with you, but then I expect you to know from a course point of view, I expect you to know only this sheet, which is static flexible, what it is called. The remaining ones are optional. If you are interested in this topic, you can explore that further and then maybe ask questions if you have, later. Okay, so all right. So let's do one more thing, then we'll close this and then do another problem. Where is the unhide thing? Okay, so now, let's forget about flexible for now. Let's actually look at the static, variance that is there, and do one calculation here, just just to build our intuition a little bit. So you have a difference of roughly around 93,000, between this 1,08,000 and this, 14,900. So if everything things had gone as per plan, which is if we had sold 12,000 units, then our profit had to be 1,08,000, but we ended up with a profit of only 14,900, right? So that is what we initially saw. And then we said that, look, that is not correct and all that. So therefore, we have to look at the, flexible budget variance. And if you look at the flexible budget variance, we are seeing that our profit shortfall is actually 29,000. So if you compare it with the static budget variance, the profit shortfall was roughly around 93,000. If you compare that with the flexible budget variance, the profit shortfall is around 29,000. The difference between these two is 64,000. Now, can you explain what this 64,000 is telling us? There is another way to arrive at this 64,000 with the data that is given on the screen right now. How do you think we can explain this 64,000, additional shortage in profit? Not the static and okay, yes, but yeah, is there a better way to put that? I mean, is there a better way to put it, or is there another way to do it? Okay, so think about it. What's the difference between flexible budget and static budget? Correct, but yeah, what is the one difference between static budget and flexible budget? That's correct, but what is the difference? No, that's fine. That is okay. But then your 2,000 units is the difference between flexible and static, isn't it? That's the answer that I was looking for. You're right. Flexible budget obviously is flexible with the amount of the units that you have. So what this means is, when you look at the static budget is for 12,000 units, and the flexible budget is for 10,000 units. So, what is the shortage in the units that we are able to sell? 2,000 units. So, keeping that 2,000 in mind, can you explain the 64,000 lesser profit that we are getting? Is there a relationship between the 2,000 units that we were unable to sell and the 64,000 number? What is that relationship? That's what I'm asking. In numbers. Yeah, but that's not the answer. See, fixed overhead is not relevant at all, right? So, because whatever is the number that I have, that number is not going to change, right? But is there any other way to interpret this 64,000? So, what I'm asking is, can you tell me the relationship between the 64,000, shortfall in profit and the shortfall of 2,000 units that we are not able to sell? I can't get more explicit than this. I can't be more explicit than this. No, yeah. So what is the relationship between the 64,000 shortfall in profit and the 2,000 shortfall in the number of units? Correct. What is that? No, that's what Tishan has been crying hoarse from that time, right? So he's like, can't you? He didn't say this, but then his attitude was like, you can't even understand this, and you call yourself a prof, right? So that's the way he was telling me. Just kidding, right? Or that's what he was thinking, right? Anyway, no. Anyway, jokes apart. What is that 32? No. Exactly. What is that 32? You guys are right. What is that 32? Do you see it on the screen somewhere? 32. That is your contribution margin, right? So what you have to understand is when you sell lesser. So Vishan's point was correct. What you're saying is correct, right? So you can generally, say that look, when you sell lesser, obviously you're going to make less profit, right? I mean, a kindergartner will be able to actually say this, but then at our level, we should be able to explain that, right? So we'll say that look, for every unit that I sell, I actually make a contribution of 32. Now, if I don't sell 2,000 units, obviously 2,000 into 32 is actually going to become a shortfall of 64,000, right? So we're actually talking about the contribution margin here, where for every unit I sell, I was supposed to get a contribution margin of $32 or 32 rupees. And since I've not sold this 2,000, that's what explains the difference between 93 100 and the minus 29 100. And that is nothing but the difference between the, somebody mentioned this, right? The difference in the operating profit between the static budget and the flexible budget is going to be 64,000, because the only difference between static budget and flexible budget is the number of units that has been sold. And if you sell less, 2,000 less, then obviously you end up with lower contribution, which will translate to the lower profitability that you have. Contribution lost, right? So the contribution lost due to lower volumes that were sold. Yeah, so we don't do that. I mean, it's there in this particular file. Sorry. No, exam it's not there. That's why I said it's optional, right? Because again, that requires a bit more detail. And rather than that, the important point is that look, as an entrepreneur, I would want you to focus on business decisions rather than focus on. So that is where your CAs will actually help, right? So whatever I was telling Nishan earlier, right? So you will get a trustworthy CA who will actually tell you what is the actual variances like this. And your job as an entrepreneur or as a manager will be what business insights you can actually get from there and what corrections you can do in the business. Okay, all right, let's go for the break. Let's come back in 10 minutes. Okay. Let's settle down, please. All right. Any questions before we go ahead? Okay. We'll spend some time understanding this budgeting process because this will be one of the most important things that you will do as entrepreneurs. Why do you think budgeting is important for entrepreneurs or founders, if you want to use that term? Yes, one of you. Okay. Right. So essentially, to plan the resources, that's one of the reasons why budgeting becomes important. Yes. Huh. Sorry, doing what best? Okay. Oh, okay, okay, okay. Uh, 1 second. Somebody has a pin. I would like to drop and see if. Yeah, it's good. Can you speak a little louder? Okay. Mm. Mm. So what will happen if you start freely distributing initially? You'll run out of things. Right. Yeah, you'll go. Yes, you'll go broke, or in other words, you'll run out of things here because you're talking about items which are there here. So that planning becomes important. Right. Right. So the company will become bankrupt. Right. Okay, whatever it is, generally, whenever you have limited resources, if that happens, then you'll run out of things where you can actually, not use those resources at a later point in time. Yes. Yeah, so essentially connected to funding, right? So if you have to calculate the runway, so one of the things that the VC will ask for when you actually go and ask them for funding is that give me a plan. So when you talk about a business plan, one of the most important components of a business plan is what you're actually going to do with the money, and budgeting becomes an important tool there. So business plan is not just about what is the kind of marketing you're going to do, what is the kind of customers you'll target, what is the kind of business model you have, etc. But in order to kind of operationalize all that, ultimately you have to come to the budget, right? So now this is how a budgeting process works, right? So typically what we do is we try to estimate what is the kind of we try to estimate what is called as a sales budget, where you try to estimate what is the amount of services or goods that I can actually sell. Typically this is for a 1 year period or a 1 month period. So if you are, somebody who is, I mean, if it's a pretty young firm, then probably you'll not do the budget for 1 year. You'll probably do it for a shorter period of time, where probably you do it for 1 quarter or maybe even for just a couple of months. And then you'll kind of keep revisiting this. Or you will say that, look, I will do a budget for 1 year. This is what I want to achieve over the next 1 year. This is what I want to roughly achieve. So that is more directional as compared to having actual numbers. But then actual numbers, you'll probably have it for a shorter period of time, where you will say that, look, things are changing so fast that I can't actually kind of plan for the next 1 year. Directionally, I have some sort of a target, but then every month I will kind of review the budget and then keep changing it based on whatever is the improvement or whatever is the business development that happen over that period, right? So that's how practically we kind of make use of budgeting. So typically, all budgeting exercise starts off with what is the kind of sales that I can hope to achieve, and then everything else is actually derived from that, right? So if you look at this, you will say that, look, okay, in order to provide the services or goods, I need to produce those services or goods. And when I'm looking at that production, I will look at what are all the things that are required for me. So if I'm in manufacturing, then I need to worry about inventory. So where I will look at, what is the kind of inventory that I need to have, what is the kind of direct budget, direct material that I require. And, it's not like inventory is going to appear overnight or it's going to appear magically, right? I have to plan for that. So if let's say that there is a particular, item that I have to purchase and that takes 2 weeks for me from the time I order, then I have to make sure that I have sufficient, quantities of that in the warehouse or in my stock, so that I can use that without disrupting my production. Or if you talk about a service organization, let's say that you are running a so let's say that you're running a firm which actually builds websites, And if you're going to take on more customers, then you'll have to make sure that there is enough headcount that you have or enough AI tools that you have, which will actually help you to build that, whatever is the service that you're actually offering, right? So what you have to understand is it doesn't matter whether you're actually producing goods or you're actually providing services. The logic is the same, that you have to make sure that enough resources are or adequate resources are available on time to make sure that the production of service and the production of your goods actually don't get hampered. So then you will look at what are all the items that go into production, right? So you need material, you need labor, then you need some sort of overheads which are there, and then you'll also need to have some selling and administrative and marketing expenses, which will all come under. So it will be driven by the amount of sales that you plan to have in the short period of time, right? So typically, marketing actually does not. Okay. By the way, why don't we see marketing here? When you look at this budget that we are preparing, we are looking at all the other things, but we don't find. Do you think marketing is important? Obviously, yes. Right? Yes. Sorry, say it again. No, but then this selling and administrative is not part of COGS, no? It's below COGS or below gross profit. Yeah, one of course there's a mistake, right? But then is there any other explanation? Okay, so typically what? Yeah, no, this is not per unit. This is at the overall firm level. It's not per unit. Yeah, that's there. Yeah, yeah. You can actually get that. So you will have variable marketing expense and fixed marketing expense. You can actually do that this one there. No, that fight is true, but ultimately, if the CMO needs money, where will the CMO go? They have to come to the. No, but then marketing and selling are two different things, right? Okay. So I think my answer to this question would be that look, your marketing is typically more long term in nature, right? So when you're looking at marketing, you're trying to build a brand or you're trying to build awareness in the in the community or in your target customers. But whereas this budget is more operational in nature. So this is more short term in nature, and that's the reason we don't have marketing explicitly called out. But I agree with Ishan. Maybe we should have a marketing budget here as well. One way to interpret that is that look, one is an error and that has got missed out. Or another way to look at this is that probably they're just calling it as selling, but whereas they actually mean both selling as well as marketing, right? So by the way, what is the difference between sales and marketing? No, targets are what? What is IDA? So I stands for interest. Oh, AIDAR. Oh, A is there also. Oh, yeah, yes. So awareness, then interest. Okay, okay. I'm not aware of this framework. So this is a marketing framework. Okay, I'll check it out. I'll check it out online. I was asking for out of my own curiosity. Yeah. So yeah. So can you say this in a more simplistic way? What is the difference between marketing and sales? Okay, IDAR, and then what was sales? What is the target of sales? No, but marketing also the. I mean, would you be happy with just does R stand for revenue in IDAR? Repeat. Okay. So what is the whole point of doing IDAR? Because you want to have extra sales, isn't it? You want to increase your sales. Is there a generic way to put across the points that you are actually saying? No, exactly. Right. But can you make it more abstract? Can you make it a little bit more macro? One second. She wants to say something. Yeah. That is branding, no? No, you use something else. what is the term that you almost said but you did not finish? You said something which you after that. Okay, so the point is, yes. Yeah. So the simple answer is that, see, marketing is more long term, but sales is more immediate and short term. Everything that you're saying can be put in these two buckets, right? So I want to make people aware. So when I make people aware, am I expecting revenue from them right now? No. I'm okay if I get the revenue at a later point in time. So if you look at this, take any example. When you look at any marketing budget, or when you look at any marketing exercise that is happening, your outlook is long term. Your outlook is not short term. But typically, when you look at any sales activity, your sales activity is that, like what Shan was telling earlier, right? So you just want to do it immediately, so which is more short term in nature. So when you look at this from this framework or from this perspective, everything that you do under marketing and everything that you do under sales actually starts making sense. So a lot of this is got to do with the kind of horizon that you have. In marketing, the horizon is long term. In sales, the horizon is short term. Are you with me? Okay, but yeah, so just to conclude this, I would have liked to see a marketing budget here as well, but probably there is I don't know, there could be many reasons. It's a mistake, or maybe it's included in selling expenses, whatever. But the idea here is that we need to make sure that all the expenses that are incurred to run the company are actually included in the budget, because the budget has to be what we call as a master budget or a comprehensive budget. It has to include all these things. And what you have to understand is, not all of them, not all of these parts will be important for all companies. So for example, if I'm looking at a mature company, if I'm looking at an established company, then I will focus on all of these things. But then if I'm looking at a service company, then this direct material budget is not relevant at all for me, because it's not relevant. And if I'm looking at a startup, then I will say that, look, I need to necessarily have the marketing expense here, because for a startup, the marketing budget also is an important part of the overall budget, the master budget or the comprehensive budget. Are you with me? Okay, all right. So then what do we do? Then ultimately, because obviously you have to maintain cash, right? So you'll have to kind of manage the cash. So then you will look at what is called as a cash receipts budget and a cash disbursement budget. Altogether, they're actually what is called as a cash budget. Essentially, you're managing a cash, right? So you're saying that, look, all this is fine, but then I have to ultimately make sure that cash is king, right? Or cash is reality, or cash is oxygen. So we have to make sure that there is enough cash to make sure that the salaries are paid, and then the raw materials are actually, the supplies are paid, and then I have to pay for raw materials if required in cash, etc. So you will look at so if you look at the arrow marks that are given here, I'll give you a couple of minutes to kind of study the arrow marks later. But then look at this. So your direct material budget will flow into the information flow from here, right? So if you go from top, from your sales, the information will flow to the budget, because to the production, because your production is dependent on how much of services or goods that I need to produce. And from the production budget, we will derive what is the kind of direct materials that I need. And from the direct materials, I will look at what is the kind of ending inventory I need to have, what is the kind of raw material I need to buy. And from there, I will look at what is the kind of cash that is required. Because remember that typically when we actually buy raw material, it is going to be based on credit. So if I have a 30-day credit period from supplier, then my cash disbursement budget will look different. If I have a 15-day credit period from supplier, the cash disbursement budget will look different, and so on and so forth. And on the other hand, I have the inflows that I'm getting here. So basically, I have the money that I'm getting from selling my goods and services. And there also, I need to consider things like average collection period, right? So what is the amount of time I'm taking to collect money from customers? How much amount is from cash sales, and how much is from credit sales, and so on and so forth. So for a company like DMart, will DMart worry about the average collection period? Why not? Yeah, so if you look at on average, DMart's average collection period is probably going to be like 2 or 3 days. There'll be some credit card settlements and all that, for which I think they'll probably take some time. But then if they're paying through cash, etc., then it's essentially zero, right? For the kind of scale that DMart has. Average collection period of 7 days is essentially like, you're almost getting a cash, almost when the sale is actually happening, right? So that needs to be considered. And then you look at what is the kind of receipt you're going to get. And once you have the cash budget, there might be some non-operational cash flows also. What do we mean by non-operational cash flows? Can you give an example of a non-operational cash flow? Yeah, so any company, when you actually put that in fixed deposit, why do you think this non-op? Yeah, so no, typically that is considered as part of operational cash flow because it is just scrap that you're selling, which is part of operation. So it's considered as part of operations cash flow. But you're right, it will not be part of the sales of services and goods. It will be other operating revenue, what we call as other operating revenue. Okay, so why is that important for a startup? Is it okay? So let me ask you like this. So this non-operational cash flows as a percentage of total cash flows, do you think that will be more important for startups or for a mature firm? As a percentage of total cash flows, don't look at the absolute numbers. Don't look at the absolute numbers of the non-operational cash flow. Look at the as a percentage of total cash flow. But where is it more likely? Why? Hmm. Hmm. What do you? Okay. See that argument is valid if you're talking about the absolute number of your non-operating cash flow. What I mean to say is that think of this example. Let's say that there are two companies, company A and company B. So company A's operating cash flow is 1,000 and non-operating cash flow is let's say 100. Okay, but for company B, the non-operating cash flow is let's say 50 and the operating cash flow is 100. Okay, so the point is, even though 100 is more than 50 for company A, so obviously now you would have realized that this is a mature firm and this is a startup. So but then if you look at it as a percentage of your total cash flow, you will see that for a startup the non-operating cash flow is roughly around 33%, but here it is less than 10%. So that's what I mean by don't look at the absolute numbers, but look at the relative numbers. That's the reason I said the proportion or the percentage is more important. Why do you think this happens? You can have some startups where this relationship does not hold, but if you take on average, a typical startup will probably have a relationship like this. Okay, why would the funds be stored? Yes, how does that happen? Yeah, you're on the right lines, but then I want this to be a little bit sharper, the answer. Ishan, you wanted to say something? That's fine. We can take it offline. Offline. Once you say offline, it's offline. No, no more discussion on that. Yeah, yeah, good. Huh. Yeah, that's the point that he made. So one point is that the sales are not going to be high. In fact, for a startup, I would say that the situation will probably be like this, where your operating cash flow is going to be minus 25 and your non-operating cash flow is going to be plus 50. Because obviously you don't have pricing power, so therefore you're actually losing money on sales, and you're investing a lot in marketing, you're investing a lot in selling expenses, etc. So therefore it's likely that your cash from operations actually is going to be in the negative. You're losing cash on your operations, right? Okay, but my question is, why do startups have as a proportion of their total cash flows, why is it that they'll have high non-operating cash flows? Yeah, so that is already being shown here, no? But then I'm talking about a inflow that is happening. Okay, now I think we're spending too much time on this. Let me give the answer and go ahead. So the simple thing is that, see, when you raise funding, do you go to the VC's office every morning at 9 o'clock and then ask him, can you give me money for today so that I can run the business? No, right? So what happens? Typically, what VCs will do is they will look at what is the kind of runway you want, what is the kind of cash outflows that you have, and then they'll say, okay, look, take this money and you run the company for 2 years, and then we'll revisit this and then we'll try to figure out as to what we are going to do next, right? So depending on your performance in those 2 years, the VCs will decide whether they're going to give a financing later or not. So this is what we call as staged financing in the VC world, right? So where VCs don't give all of the money, and they kind of give it in stages, so that they want to see how you actually, what you're actually going to do with that money, and whether you can actually prove yourself, right? So typically what happens is that startups end up with a lot of cash initially when they've raised those funds, and then those funds are typically invested in fixed deposits and other short-term investments, because actually need those funds over the next 6 months or 1 year, and that's the reason they have a lot of interest income that is there. In fact, if you go to historically, I think 3-4 years back, not 3-4 years back, maybe a couple of years, if you go back and look at when Zomato first turned profitable, so they made a huge cry saying that, oh, we have turned profitable this quarter, etc. But one of the criticisms for that, or at least in my exam, one of the criticisms for that was, if you look at it, Zomato was actually not profitable from operations. It was profitable because it was getting other income, which was interest income. That's because they had got, they had gone public, and then they had raised a lot of money, and that money was actually invested in fixed deposits, etc. So technically, yes, Zomato is profitable if you look at the P&L. So they had a positive profit number. But then, as if you do something called as earnings quality, we will say that, look, the profit actually is coming from other income and not actually from the normal operations. We kind of we discussed a similar point when it came to Lenskart as well. So when they actually went for the IPO, they were able to show a positive number because they sold some old mutual funds, and then they kind of booked the capital gains which they had on the old mutual funds holding that they had, right? So is this fine as to how yeah, go ahead. Um, yeah, good point. I think probably they have done that to indicate that it is kind of related to your sales. So the point is that don't look at it as money, look at it as information. So the arrow marks that you have here is actually the flow of information. It is not the flow of money. So the flow of information is that if you have more sales, then you will end up spending more in selling expenses, right? So in terms of commission, etc. And that's the flow of information that you are talking about. Exactly. Yeah, I think that you put it across correctly, right? So to make a selling budget, you need information from sales. So the arrow marks that you're seeing here is the flow of information and not the flow of cash or not the flow of profit. Okay, and yeah, finally we end up with we have a budgeted balance sheet, budgeted income statement, and budgeted cash flows. So that we can actually do this overall kind of analysis that we did. Like, so the the flexible budget variance and the static budget variance that we spoke about, that you can do only when you have an overall income statement. So ultimately, what you're trying to do here is that you're trying to say that, look, if we need to understand the overall way in which the company has performed, I necessarily have to look at financial statements. And so you're linking the costing bit or the management accounting bit with the financial accounting bit here, where you're trying to say that overall, if I need to understand, if I need to compare what has been my performance with competitors. So when I look at competitors, maybe I will get only this information. That is, I will get only the financial statements. Obviously, I will not get all of this information because that is internal. So companies are not required to disclose this. So if I need to compare my performance with a competitor, then I have the internal information for my company. So then I will prepare all these financial statements, and then I will compare my financial statements with competitors, and then figure out as to where I'm doing better than them, or where I'm actually not doing, what is the area for improvements. Are you with me? Okay. One more reason, because VCs also actually want this. So whatever is information that is there here, VCs also require this information. So they ask for monthly financial statements as well as other information that is required, so that they can monitor the business. Okay, so we won't be able to do this budgeting problem fully, but since we have around 10-15 minutes, let me actually go through that, at least give you some idea as to how this happens. So please read this question, and then we'll do some part of it, and I will leave the Excel file for you as optional reading material. So please go through the question just to get a sense of how we think about budgets. And by the way, whether you're doing it for a mature firm or whether you're doing it for a young firm, the process is going to remain the same. All right, whatever is the process that we're talking about here in terms of preparing the budget. Want me to zoom? Okay. I'll make it into two parts. Is this fine? It's too big? Yeah, I think the width is too big. Just give me 1 minute. Let me just get. Okay, at least the width is fitting. Yeah. So please go through this. Then I'll scroll down. Okay, that's a trick that is used in textbooks, because when you're talking about, that's just the year that is there, right? So I can interpret that 20x8 as 2028 or 2038 or 2048 or 2008. So that's just a trick that is used in textbooks. So you don't have to update the numbers. That's all. But yeah, you can take it as 2018 and 2017 if that is more, comfortable. Okay, let me scroll down. Ah, okay. So whatever required to do, we are supposed to get all the the different budgets that are there in place, right? So what we saw in the in this particular figure, so we'll start with the sales budget, and then we will look at a couple of other things, and then we'll close the class, right? So so for sales budget, what we'll do is we lose information that has been given here, right? So now, by the way, how did the company come up with all this information? Whatever is information that you read now, how do you think the company would have come up with that information? Huh? Yeah, so basically based on your previous experience, right? So you will kind of look at what happened last year, and then you will modify the budget. So your starting point for the next year's budget is typically the actuals of the last year, right? So you look at the actuals of the last year, and then you will see whether there is any question of expanding or any question of reducing your activity, etc. If that is not the case, then you will just take that as the benchmark, and then you will prepare the budget for the upcoming year, right? So that is how the budgeting process actually happens. Okay, so now given that we have the sales, and then we have the selling price per unit, we can prepare a schedule here. So we can say that the quarterly numbers that have been given to us, which is the 2000, 6000, 8000, and 4000, you just put those numbers here in terms of the sales in units. So that gives you a total sale of 20,000 for the entire year, and then you have the selling price that is not changing, right? So even though we say that the question says that it is seasonal, just to keep things simple, the selling price has been fixed as being constant. But it's also possible that you might be able to sell a higher at a higher price in some quarters, and lower sales in some quarters. But that also can actually be incorporated here, right? But for now, we are assuming that the selling price is constant, and that gives us what is the total sales revenue that we are expecting. So sales budget is actually quite simple. The challenge in sales budget is getting a reliable estimate of these numbers. That is the number of units that you will be able to sell and the price at which you'll be able to sell. That is the more challenging one, but the arithmetic is quite straightforward when it actually comes to the sales budget. Are you with me? Okay. So once you have the sales budget, then we will prepare what is the kind of cash inflow that we are getting. I'm just following the same order which has been given in the textbook, where we are saying that okay, now that we have made the sales, remember that we are not collecting all the cash in the same quarter, right? So as the question said, do we have pin drop silence? Sometimes I wonder if I'm teaching undergraduates or I'm teaching kindergarten kids. Yeah? What I don't understand is there's so much of technology, right? If you really want to talk, you can just WhatsApp each other. Do I have your permission to continue, both of you? Now you're not talking. When I'm asking a question, you're not answering. But then when I ask you to keep quiet, you're talking. Yes, ladies, tell me. Do I have your permission to continue? I'll not move forward until I get an answer. Thank you. Okay, so if you look at the collections that are happening here, what does the question say? The question says that with the experience that Solar Tech has, in the same quarter, it will collect 60% of the sales, and in the next quarter, it is going to collect 40% of sales. But the important thing also to remember is that the bad debts are actually not that significant. So we're ignoring that as part of the budgeting process, right? So because what you have to understand here is that when we actually prepare a budget, while we want to make sure that we are actually we're preparing that at a sufficient detail, we can't take every possibility into account. So we will take only the material possibilities into account, things that actually are substantial. And for small things, we will just have a buffer at the end, right? So because every budget that you prepare will also have something called as a contingency allowance, where you will say that, look, this is the plan, but then plans are made so that we know that things are not going to go according to plan. So we will have like a 10% margin, which will enable us to handle any last minute surprises that are actually going to come, right? So but anyway, so here we have assumed that there are no bad debts, or the bad debts are actually quite small, negligible, as the question says. And so in the budgeting process, we're actually going to ignore that. Okay, so now the important thing is, when I'm preparing my cash receipts budget for quarter by quarter, the first thing is I start with the sales revenue. So remember that everything is linked, right? So this is what I meant by the information is flowing. So the information is flowing from the sales budget to the cash receipts budget. So I look at what is my sales revenue for quarter one. Then I will say that now whatever was the sales in the previous quarter, I am going to collect it in this quarter. So this is the quarter one of 2008 that we are doing the calculation for. So whatever is the sales that I made in the previous quarter, I would have collected 60% of that, right? So now if you go back to the question says that for the last quarter of 2000, my sales are expected to be 1 lakh. That is 4,000 units. 4,000 units into 25 is going to be 1 lakh. And then this 1 lakh, I am actually going to collect 40,000 out of it. Sorry, I made a mistake here. This 60% is the current quarter sales that I'm going to collect. So this 50,000 into 60% will be the quarter one sales, the cash which is being collected in the same quarter. And the 40% that I spoke about will be the 40,000 of the 1 lakh which is there of the previous quarter. Sorry, I got confused there a little bit, but I hope it is clear, right? So with the comment that is there here. So let me repeat this once more so that there's no confusion. In this quarter, I sold 50,000 worth of goods. out of which I am going to collect 60% in this quarter. And I know that 40% gets collected in the subsequent quarter. So in the first quarter, I'll be collecting 40% of the previous quarter sales, which is 1 lakh, right? So what you have to understand here is, given the nature of this cash collection, the sales which I record in my books will be different from the cash that I have collected from the customers. That is the reason we need a separate cash disburse or a cash receipt budget, when you have this credit period. So, but for a company like DMart, this probably is going to be almost similar, because DMart actually collects the cash almost immediately. So therefore, there will be less difference between the cash receipts budget and the sales budget when it actually comes to a company like DMart. But here in this case, since the company collects only 60% in the same quarter, your 100% of the cash collection that you have, 60% will come from the current quarter sales, and 40% actually will come from the previous quarter sales, right? So look at this. So so in the first quarter, if I have sold 50,000, the 30,000 is collected in this quarter, and the remaining 20,000 actually comes in the next quarter, right? So this 30 plus 20 comes to 50. Similarly, 90 plus 60 comes to 150, and so on and so forth. 120 plus 80 comes to 2 lakhs, and so on and so forth, right? So you can see, obviously, this is an important input if you have to plan what is the kind of cash balance that you're going to have, and what is the kind of cash outflows that you can commit yourself to when it actually comes to the budgeting process. Are you with me? Yes. Yeah, that's correct. So that is why I can do that only for Q1, Q2, Q3. I can't do that for Q4, because in Q4 I have sold 1 lakh here. So out of that 1 lakh, 60,000 is coming here, and in the 2009 quarter one, I will collect the remaining 40,000. Now, was that your question? Yeah, yeah. So yeah, so I mean, we are so we're assuming that the no, no, no. Yeah, yeah. The total will not be the same, depending on what is the actual numbers that you see. Yes. Okay. Why do you think that happens? No. Yeah. Okay. I'm asking. I mean, for the class. No, not specifically to you, but why do you think that happens? Huh? Okay. Hmm. Okay. Right. So think of it this way, right? So let me actually do it in Excel, because I think the calculation will be simple. It's important to get some intuition for this. So let's say that in a month, which has 30 days, okay, let me zoom out a little bit so that we can see everything. Let's say that in a month, every day you are making sales of say 5,000. Okay, let's assume that the sales are constant throughout the month. So you have made a sales of 1,50,000, right? Is that correct? Yeah, you made sales of 1,50,000. Okay, are you with me? So this is the sales that you made in this particular, in this particular year, in this particular month. But then the cash collection you're going to get, the cash collection you collect after 15 days. Okay, or let me make it 10 days. So the cash collection or the average collection period is going to be 10 days. So what does this mean? It means that the sale that you made on the first day, you're going to collect it on the 11th day, because there is a 10-day delay between the sales that you made and the cash that you're collecting. So the cash that you collect on the 11th day is going to be the sale that you made on the first day. Similarly, the cash that you collect on the 12th day is going to be the sales that you made on the second day. So on and so forth, right? So if I drag this down, what is it telling me? It is telling me that whatever is the sales that I made in this month, I collected only 1 lakh out of that. The remaining one is actually going to come in the next month. So based on their past, history, they have determined that roughly around 67% comes in this month, in this particular example, and the remaining 33% will come in the next month. So it's a function of what is the amount of credit period that you are giving. So let's say that if I give a shorter credit period, let's say that I give no credit period at all, I collect the money on the same day itself, then I'll collect 100% in the same month, because everything is actually going to come in the same month. So that's why I said that that's the difference between your sales budget and the collection budget. So this cash receipts budget is nothing but the collection budget that we are speaking about. Are you with me? Okay, right. Okay, then I don't know if you have time to do. Okay, we'll do one more and then we will close. And then actually, no, I think this will take more time. So what you have to understand here is, again, I will keep these two as part of the course. Whatever we discussed in the class, I'm going to keep it as part of the course. And the remaining ones, all we have to do is that we have to follow the question that has been given here. This is optional, so you don't have to worry if you're not interested. But if you're interested, all you have to do is look at the details that have been given here in terms of how much of production gets done and how much of raw material or how much of inventory that I need to carry, and accordingly you will prepare what is the kind of production you're going to have, what is the kind of raw materials that you have to purchase, and finally what is the kind of cash outflows you're going to have. Like remember that, like how we give a credit period to customers, we also get a credit period from the suppliers. So just because we buy the inventory this month doesn't necessarily mean that we have to pay it for this month itself. And if you look at the cash disbursement budget, what the data that we have is that in the current month we pay only 70% of whatever is the purchases, and the remaining 30% actually is paid in the following month. Are you with me? Right. So the first two things are part of the course, and whatever we have actually discussed in the class, the remaining ones are optional. Even though I'll share the entire file with you. Right. Okay. All right. So good luck with everything. This was the last session, and yeah, I mean, whenever you have any questions on costing, feel free to email me. Yeah.